The broadcast is now starting. All attendees are in listen-only mode.
Okay, let's go ahead and get started. I'd first just like to say welcome to everyone that's joining us both live and on the recording. I want to thank you so much for joining us. I am, of course, Eric Thompson. I am here in Colorado with Windermere and with the Windermere Leadership Academy. I will introduce our guest, our featured speaker here in just a minute. And this is, of course, a two-part webinar series called Bomb-Proof Your Business. This is part 2 of that series where we focus on balance sheets, and just really looking forward to today. And again, just want to say thanks. Just want to say thanks to all of you that have committed the time to attend both these webinars, whether you're watching live or watching the recording. I want to say thanks to all the nice feedback that we had. We had a lot of nice feedback that came after the first webinar. And here we are on the second one. And we are going to start with a little bit of fun, kind of like what we did last time. I always like to make sure that we're coming through loud and clear. And given that it's football season, could you type in the team that you're rooting for this weekend? And this is a big weekend, especially in college football. We have Washington ranked really high in the polls. We have Oregon that has a big game. My Colorado Buffaloes are traveling to, of all places, traveling to Michigan, going to the Big House. I'm actually going to be there. I'm going to meet some college friends there for the weekend to go watch Colorado play Michigan. That will be quite the experience. Not too hopeful that my team is going to do well out there, but it'll be pretty neat to be in a stadium of 100,000 plus people. But use that question tool that GoToWebinar has to type in the team that you're rooting for this weekend. I just want to make sure that we are coming through loud and clear. So you may be rooting for the Huskies, rooting for the Ducks, rooting for the Seahawks, or the Broncos, or the Buffs, or whoever it may be. And yeah, I see some good comments coming in. We got some Broncos comments. We got we got a Michigan comment. Oh, that's not good. We got Go Dogs. So we are coming through loud and clear. So so that's fun. So thanks a lot for doing that. And now I want to say thank you to our esteemed guest. Mr. Mark Oster is our Chief Financial Officer of Windermere Real Estate. And so Mark, welcome to you. Thank you again for being our featured speaker.
Thanks, Eric. It's great to be here again.
Yeah, awesome. And yeah, we're just so grateful that you're joining us again. You offered tremendous value last time in the webinar, and I know you have lots of great information to share today as we talk about balance sheets. And I was just sitting here thinking before we kicked off that you, Mark, in your life, you've seen a whole lot of balance sheets, right? And
I have. I've
yeah,
seen lots and lots, both
yeah,
good and bad,
yeah,
and in between.
Yeah, right. Kind of the good, the bad, the ugly. Word today is called the beautiful balance sheet. So I know you've seen some beautiful ones, and over the course of your whole career, maybe seen some ones that are not so beautiful. And we're going to tap into all that great experience that you have today. So, gang, today is called, today's theme, today's title for this webinar is called A Beautiful Balance Sheet. And as I say that, I kind of want you to imagine like the angels singing, right? Like you're looking at your balance sheet, and you know, the sun's shining, the birds are chirping, and you just have this beautiful, this piece of art, this amazing balance sheet, right? That you've created from all the wonderful things we're going to learn from Mark in this webinar. So that's what we mean by a beautiful balance sheet. That is our focus for today. So specifically, this is what's going to happen in today's webinar in the 1 hour that we are together. This is the plan. We are going to show you both cash flow and cash management strategies. Mark is going to focus on that, give you some really good takeaways, some good strategies when it comes to cash flow and cash management. He's going to give you some cash reserve rules of thumb. You know, we all know as owners we need to have cash on hand, but you know, how much should we have on hand? What are some rules of thumb to follow? What are some formulas to have in mind that we can focus on so we can have some really good goals when it comes to that? And then also Mark is going to give us some asset management strategies. So how about when it comes to our building? You know, maybe we own our building or want to own our building, and what do we do when it comes to our office equipment, and how does all of that weigh into our beautiful balance sheet? Mark is going to walk us through that. And guys, as I look at this, session today, as I think about this, as we were putting this together, really how we look at this is that, this is just some really good accounting 101. These are really good foundational elements of accounting, just some really solid basics that we as franchise owners need to know, need to understand, and we're blessed to have Mark walking us through this. So why are we talking about this in the first place? Well, here's the deal, guys. Times are good. We sure remember when they weren't. It wasn't that long ago. So let's bomb-proof our business. And one reality is, and we've learned this from Matthew Gardner, our chief economist, is that the next recession is closer than the last one. And no, we don't expect the big giant recession like we had last time. But the reality is, as we all know, this market cycles. Real estate goes up and down. We are in an up cycle right now. There will be another down cycle. And I would tell you that as Mark and I first talked about the whole vision for this series, it's really was this webinar that kind of started it, or the thought of this webinar, and it's really this slide that was on the mind of Mark and I as we were talking about this. It's just simply, times are so good right now. Let's make sure that our owners are positioned really well going into the future. Let's make sure we're making the most of today's market and really using today's great harvest, so to speak, leverage that into setting our company up for the future. And because the market will cycle down, we remember when times were tough, and we just want to help you out. We want to make sure that you have a good experience the next time that the market cycles down. So that's what's on our mind. That's our mission. That's what we're after. And Mark, I just want to make sure that in your mind I got all that right, and we're really hitting and we're clarifying the why behind this. So anything you would want to add to that?
Absolutely. I think we all saw what happened in the downturn, and saw some not so good results from some of the brokerages, unfortunately, and just want to make sure that you're prepared for that in the future, maintaining proper cash reserves, et cetera. Again, to reiterate, we don't think the next economic downturn is going to be what it was in the past. But that said, I just want to make sure you're looking forward to that, and when it does hit us.
Yeah, that's right. That's right. And the reality is, times are so good right now. Let's just make the most of it. Let's really, leverage that to get our companies in a really great position going forward. So that's, it's always good to start with the why. Start with the big picture. That's why we're focusing on this. And next, we'll move to Mark, just some basics, right? Let's just start with the basics. Some things that may be maybe not worth saying, but let's say, and let's just kind of lay the foundation here as we look first at just some simple cash flow, cash management thoughts. Whoops, Mark, just kind of tell us about these few things here on the slide.
And to reiterate, yeah, these are the basics, but I think it's important to point out. And so obviously, looking at building up your cash reserves during the selling season. Contemplating planning for seasonality in your business. Cash flows in your business can sometimes be smoothed out using anniversary versus calendar agent commission plans, so that's a possibility, perhaps even as you're looking at taking on new agents to try and smooth out cash flows. And let's not forget to talk with your tax accountant. You certainly don't want to have surprises come up when tax time occurs.
Right. Right, exactly. So, so again, these are just some simple basics, a good place to start. And another good place to start, as we talk about a beautiful balance sheet, another good place to start is, well, what is a balance sheet anyway? What is a balance sheet in the first place? And I know a lot of us already have a good understanding of this, and even if you do, it's worth kind of reinforcing, reiterating, it's worth reviewing. So, Mark, let's take a couple slides just to make sure that people really understand what a balance sheet is in the first place.
That's right. I think it's important to understand your balance sheet to manage a number of things. First, it can help you manage your cash flows as well as the overall health of your company. So let's just answer the question, as Eric stated, what is the balance sheet? Essentially, the balance sheet is a snapshot of your business financial position on a given day, usually measured at month end or at year end. Essentially summarizes your company's assets, liabilities, and your owner's equity, and we'll go over what those are in a few minutes. Also later, we'll go over a few financial ratios that are commonly used to evaluate the strength of a company's balance sheet, and are also useful for cash management tools.
Got it. Great. So maybe one way to sum it up is that it offers a whole lot more than just your bank statement, right? So this is more than just, well, how much money is in the bank, how much cash is sitting there. There's more to it than that, and it provides a more comprehensive look at your company, right?
That's correct. And so, as we'll see in the next slide here, we'll kind of go through a few things. First, why is it called a balance sheet? And that's because it essentially balances. You take your total assets equals your total liabilities plus your owner's equity. So the components of that, if you take a look at your assets, those are things the company owns to provide future value and costs paid in advance, such as prepaid expenses. As we'll see later, a crucial component of analyzing the ratios we'll discuss involves understanding current assets and current liabilities and ensuring that those are properly classified within your balance sheet. Now, current assets are defined as balance sheet accounts including cash or other assets that can be reasonably expected to be converted to cash within 1 year. Liabilities essentially are obligations of the company that are owed to others. Current liabilities are defined as items that will be due or payable within 1 year. This also includes the current portion of your debt payments. Owner's equity is essentially everything else to make it balance. It includes owner cash contributions into the company, plus retained earnings, which are essentially cumulative historical earnings of the company, less any owner cash distributions.
Okay, that's great. And one thing I'll interject here, gang, everyone that's listening live, feel free as we go along to use the question tool in the GoToWebinar program to send us any questions that you may have as we're going through this. So I know sometimes in other webinars questions are always saved till the end. We won't do that this time. If you're having questions about any of this as we go along, it's likely that someone else is having the same question. So just feel free to use that question tool in the GoToWebinar to fire us off a question. So Mark, just simply looking at this, we see these colored boxes. How a balance sheet works is that everything that, if you add up everything in the green, it's going to equal everything that's added up on the blue. That's why it's called a balance sheet, because all those things balance, right?
That's correct.
Okay, great. All right, so that's just kind of the basics of the balance sheet. It's the assets on one side, it's your liabilities and shareholders' equity on the other side. Those things balance out. Again, it gives a really nice, real comprehensive picture of what's going on in your company. And now let's roll into, after we've had this good understanding of a balance sheet. By the way, we're going to look at an example one here in a couple minutes. We're going to put some real numbers to this. But before we do that, let's just give you an overview of some cash reserve rules of thumb that we are going to talk about. First two are pretty basic, and then the next two we're going to go into more detail, right, Mark? So let's just cover these first two real quick.
Right. For me, the most important thing is essentially setting a policy that makes sense for you. Make sure you understand what's in your pipeline, and don't forget to keep what's coming due along with your pipeline in mind. So you might decide simply to set a policy of maintaining 3 months of expenditures aside for a rainy day. That's one that's commonly used, or setting maybe it's 2 months, but setting something that works for you is really what we're looking at.
Great.
Now there's
go ahead.
We also have 2 other ratios we're going to be talking about. Now that we have an understanding of the balance sheet, we can discuss these ratios, and those are the current ratio and the fixed charge coverage ratio that we'll talk about shortly.
Okay, and so to go through those last two guys to show you how the current ratio works and how the fixed charge cover ratio works, we're going to show you some specific examples, and we're going to use some example balance sheets and also income statements to walk you through exactly how these work. And I'll tell you, especially when it comes to the current ratio, it's just a really nice way to set some clear targets about cash reserves in your company. It's a ratio personally I've used before to help me manage the balance sheets of the companies that I run, and it's just a really nice way to set goals and set a target. And before we go into detail of the current ratio, Mark, let's look at this example balance sheet. So let's take some time here and just walk us through this.
Right, and so what we're seeing on the left side is just a sample of a brokerage balance sheet in summary level here. And as you can see, we have the current items we talked about are cash. We've also got the trust account if you happen to have a trust account. You've got prepaid expenses and agent accounts receivable. Those items are reclassified as current on your balance sheet. Then we've got fixed assets, your property, equipment, et cetera, perhaps your leasehold improvements, things of that nature. And then you've got other assets. Perhaps you have a lease deposit or other items that are classified as non-current for your total assets, adding basically your current plus your long-term items to get the total assets. Then below we have essentially accounts payable, your other current liabilities that might be perhaps it's accrued payroll, things of that nature. You've got the current portion of your long-term debt. Now that's the payments that'll be due within the next year. And then again, you've got your offsetting trust account for total current liabilities. That plus long-term debt gets your total liabilities. We've got your owner's equity here at 105 grand in this example. And that again is essentially your contribution of capital plus cumulative earnings less any distributions that have been taken out. And as you can see, all of those balance. So total assets is 600,000. Total liabilities and owner's equity is also 600,000, and they balance.
Okay. You know, as I was looking at this, a thought that popped in my mind, and may have popped in other people's mind as well. The trust account, why would that show up as an asset? It's not our money, and that's why it shows up as a liability, right? That's
exactly right.
In both those places,
and
right?
So one thing we'll talk about in a moment is you know, how we should be accounting for that with these ratios, because as Eric said, it is not our money, and essentially where it's recorded as an asset, but also a corresponding liability, and essentially it offsets to zero, of course. And so confusing, however, when we're talking about these ratios, and it can lead to the wrong answer in your ratios, as we'll see shortly here, unless you make a modification to those calculations. And so what we're looking at here is a healthy balance sheet, and as we go through some of the ratios we'll discuss, you'll learn and understand why.
One thing to point out, to make really clear, especially before we go to the how the current ratio works, is Mark, again, walk us through that line that says current portion of the debt, because that's really important to understand before we talk about the current ratio.
Let's pretend that you have, so the current portion and the long term, you've got 110,000 outstanding. The current portion, let's say that your total payments are $2,000 per month, and of that, 4,000 of those current payments will be interest. So you're going to pay $24,000 out in the next year. 4,000 will be interest and recorded as interest expense, and $20,000 will be reduction of principal. That $20,000 reduction in principal in the next year is what should be classified as the current portion of your debt.
Okay, got it. That makes sense. That's really helpful. And I'm just kind of pausing here before we go to the next slide, just to see if anyone has any questions about this example balance sheet before we move on. Doesn't seem like it, and so you said that this is a healthy balance sheet. Now let's go see why you think that. Let's go put some specifics to that. Let's put some numbers to that. And the specific number we're going to look at is something called the current ratio. So let's start with, Mark, just the basic definition of what a current ratio is.
Right, so the current ratio is a ratio that measures the liquidity in your company. Essentially, it's measured by taking your current assets divided by your current liabilities. And we describe what current assets are, but as a recollection, it's essentially items that will be converted to cash within a year. That number divided by your current liabilities, anything due within a year. And so what you're looking at is looking at a target of anywhere between 1.5 and 2.0. Now, we talked earlier, for those that have a trust account, I'd ask you to modify this ratio to exclude your trust asset and your trust liability, and this will be demonstrated here shortly.
Okay, so just simple basics. Take your current assets divided by your current liabilities. Well, what's a current asset? It's anything that's liquid. What's a current liability? It's just 1 year's worth of obligations, and you want to set a target between 1.5 and 2. And what I've been taught, Mark, and let's see if you agree with this. What I've been taught is if you're at 1.5, that's really good. If you're at 2, that is beyond good. That's excellent. That's fantastic. That's a bomb-proof company, right? If you can get your current ratio to 2.0, you have achieved bomb-proofness, which you concur.
Yes, you have.
With
basically,
that?
it's telling you that you can afford, twice your expected obligations in the next year, and so it's giving you that cushion. So yes, I would agree with that. But it's also setting you up to help out from a downturn in the economy, things of that nature. So you also want to look at these. That's why we call it targets. The targets can change based on the circumstances, and so knowing that times are good right now, but we think the economy might slow down, you might want to start ratcheting that target. Let's say you set it at 1.5. You might want to say my goal at year end is to be at 1.7, knowing that you want to look towards where that economy might go.
Okay, that's great. That's really great feedback. So now let's take this this definition, let's take this lesson, and let's go apply it to that example balance sheet that we just looked at. So let's go see how this really works. So now, Mark, take us through what we're seeing here.
Right. As you can see, this slide displays the balance sheet we just reviewed. And as you can see, the current ratio is calculated here with the modification for removing the trust account asset and liability. So essentially, total current assets of 465 less 300,000 in the trust account leaves us, I'll call it a modified current asset of 165,000 divided by the difference between current liabilities of 405,000 less the trust account liability of 300,000 is 105,000. It gets you a current ratio of 1.6. Now, it's important to note that had you not adjusted for the trust account, it would disclose a current ratio of 1.2 instead of, in this example, a healthy 1.6. So if you have a debt or a line of credit that requires you to maintain certain current ratio covenants, it's important to ensure that your banker understands the potential impact of the trust account and adjust the covenant calculation accordingly.
Okay, that's great. So just to make this point even more clear, and just to help us out, what would it take for this company to be at a 2.0 ratio if you're able to do just that quick math?
Well, basically, you would have to you'd have to either increase your assets up to your current assets up to 210 grand, or reduce your current liabilities down. So a 2.0 is basically 2 times the current liabilities. So either you need to get your assets up to double the liabilities, current liabilities of 105, which brings it to 210, or a combination of increasing your current assets and your current liabilities accordingly.
So if you can, just simple guys, if in this company, if you're sitting there at 1.6 and you want to achieve full bomb-proofness, you just need to get that 165 up to 210. So I'm doing the math in my head. What's that, Mark? $55,000 more cash in the bank would get you there.
That's correct.
Okay. Great. Okay. That's super helpful. Okay, so again, just going to pause for a sec to see if anyone has any questions here as we talk about the current ratio. And again, guys, this I found personally this current ratio is just it's simple, it's easy, it's straightforward. It's a nice target, and it's the other thing I liked is it's a little more advanced than just have 3 months worth of cash in the bank, and it'll help you sleep at night, right? You get to 2.0, it'll help you sleep at night. So we are going to, in a sec, Mark, we're going to move on to another ratio to look at called the fixed charge cover ratio. And before we do that, though, we need to look at an example income statement, because the income statement will play into this. And so let's, Mark, if it's okay with you, let's look at an example income statement. And I'm thinking that most people listening are very familiar with income statements, so I don't think we need to spend a ton of time here, but just give us kind of the basics and help us understand here what we're looking at.
Right. So again, I think everyone's pretty familiar and analyzes your profit and loss statement pretty closely, but needed to provide the example so that we can help with our calculations here. But that said, I wanted to point out a couple of things that I like to analyze with the income statement, and that is the percentage of gross profit or company dollar. You can see that I've got gross profit percentage sitting here, and then I've also got your expenses as a percentage of gross profit. And this kind of plays into some different ratio analysis that in line items analysis and allows you to compare yourself to different benchmarks having that. I also like to take a look at it and say, what is each line item by agent? And so you can understand what return each agent is providing to you.
Got it. Yeah. Yeah, that is nice just to look at it on a per agent basis. You don't see that too frequently, but that would be a nice little thing to add for any of the owners that are listening right now. Look at it on a per agent basis. I like that a lot. Mark, as we're looking at this, this makes me think of, and I want to make sure that everyone listening knows about a tool that's out there. It's a guide that we put together. It's called the Profit Blueprint. And the Profit Blueprint, I'm guessing some of you may already know of it or have seen it. The Profit Blueprint, what it is, if you haven't seen it, it walks you through exactly how to set up your budget resulting in a 30% return. So the whole goal of the Profit Blueprint worksheet and guide and webinar recording is to get that number there that you see, percent of gross profit, to be 30%. So it shows you exactly how to allocate your expenses. It's based on my research of the most profitable companies that I've been around, that I've come across, that I've been able to look into. And if you want that, just send me a note right now or email me later, but you can send me a note right now that says, just have it say Profit Blueprint or Eric, I want that, or send that to me, or however you want to do it. I'll get that in your hands right away. I think you'll find that to be a really nice tool. So what you'll get is a recording of a webinar and also a worksheet. And the worksheet shows you, again, exactly how to set up your budget so you end up with a nice return for all the efforts that you put into your business.
I'd like to emphasize too, so I've watched the webinar myself, and I agree it's a very valuable tool. The layout of the Profit Blueprint is very similar to what you're seeing here from a P&L perspective, and which is also, by the way, the same type of format that is used in the roundtable that we put together that allows for comparison of brokerages compared to averages and means for the brokerages in the summary.
Awesome. That's great. So again, if that's something that would help you out, if you'd like to see that, just shoot me a quick note or use the question tool there in the GoToWebinars. Says Eric, I'd like that. Get that in my hands. I will get it right off to you right away, and you'll have that as a resource for you. Okay, so Mark, now we've looked at the income statement, and we all understand what's happening here, and we had to do that to tee up this next slide, where we're going to talk about another ratio, and this is another rule of thumb to have, another kind of another tool in our tool belt, and that is this one called the fixed charge cover ratio. Now, here's how I look at this, guys. I look at, going back to our football metaphor, our football theme, I look at having 3 months of reserves in the bank. You know, that's kind of, that's nice, and it's also maybe kind of junior varsity level. I think the current ratio, maybe you could call that, we're now at varsity level, and now, Mark, if we're getting into fixed charge cover ratio, now we're in the big time. This is, Division I football that we're playing here. So useful ratio, and it may not be necessary for some, certainly worth understanding, worth looking at. And you may find that the varsity level, the current ratio is enough, that'll be good for you, but this is worth talking about nonetheless, because this may be useful for some people who are listening. Is that metaphor okay? Is that working for you, Mark?
I think that's a good one. I think
right,
really, I like the fixed charge coverage ratio for a few reasons. That it really helps me to analyze it from both a cash management perspective as well as measuring the health of the company. Also, if you do happen to have debt, this is a common ratio that bankers will put into the debt covenants you might have. And so even if you don't use it from a cash management perspective, I still think it's a useful tool to kind of analyze the overall health of your company. So let's talk about what is the fixed charge coverage ratio. First, essentially, the fixed charge coverage ratio takes EBITDA, and EBITDA is essentially defined as your earnings before interest, taxes, depreciation, and amortization. Now, there's a point of clarification here. Taxes refers to income taxes in the business, and since most of our brokerages are set up as S-corps or LLCs, most brokerages don't see taxes entered into this calculation. We'll talk about distributions here shortly, and that's where the taxes will come into play for most of our brokerages. So now that we've defined EBITDA, let's complete what the calculation is. It's essentially EBITDA divided by your principal and interest payments that are required over the last year, plus owner withdrawals. And essentially what this ratio is saying is, did you have enough cash generated from the business to cover your cash outlay for debt and owner withdrawals? Your target on this is at least 1.0. If it's less than 1.0, you're essentially taking cash out of the business.
Got it. Okay, so pretty simple. We take EBITDA divided by your P&I payments plus withdrawals. So EBITDA again it's your earnings. It's you know, some people may shortcut that to just say it's your profit. And so it's earnings before interest, taxes, depreciation, amortization divided by P&I plus withdrawals. Targets 1.0 or higher. And just like we did last time, what we're going to do is look at this in real life using numbers here. And so let's go back to this income statement that was the example, and let's apply what we just learned about the fixed charge cover ratio to this.
That's right. And so yeah, you'll recognize this income statement that we talked about earlier. And if you take a look at it, you'll see that line item called EBITDA. Now that's a line item that's not traditionally displayed in an income statement, and it's usually something that is calculated going backwards, taking net income, adding back your depreciation, amortization, and your interest expense to get to the EBITDA number. But for display purposes, I wanted to show it here in this manner. And then you can see basically you're taking your EBITDA. Now let's go to that example we talked about earlier with your debt. And so what we said essentially is that you have monthly payments of $2,000 for the last year. That's going to total $24,000 in payments for the year. Of that, you'll have $4,000 in interest expense, and $20,000 will be principal payment reduction. So essentially you take your principal, your interest, and let's pretend that you took out $100,000 from your company to cover your pass-through tax expense as well as a return of capital. And so basically the grand total of that is $124,000. So you take your EBITDA divided by the $124,000 to come up with your fixed charge coverage ratio of a healthy 1.3.
Got it. Okay. So to make it up, Mark, if this if the owner withdrawals, if that was $200,000, then that number would not be so healthy and would not be achieving the target of 1.0 at a minimum, right? And it would be then we're showing that we're taking too much cash out of this company, right? And
that's right. In that example, you would essentially be at a fixed charge coverage ratio of 0.7, meaning it's less than 1, and you are taking cash out of the company. You're taking excess cash out.
Okay.
Now, in some cases, you know, that might be something where, again, if you're looking at ratios and maybe you're going into a strong economy versus where we think in, you know, going into 18, we might be having a slight downturn. You might actually want to be at a reduction because you want to put the money, you know, return your capital. But so, you know, these rules aren't all set in stone, but it's kind of looking at your overall circumstances and kind of defining what makes sense at that current time.
Okay, that makes sense. So guys, we just went through three strategies for your cash management. One is a very simple one, keep 3 months of reserves in the bank. Another one was a little more advanced, it's called the current ratio, where you just take your current assets divided by current liabilities. Again, the target there is to be between 1.5 and 2.0. And then we just went through the fixed charge cover ratio. I think the name of it almost makes it sound more complicated than it really is, but you walked us through that again, and the target is to be at least a 1.0. And with that one, you're really watching how much cash that you're taking out of the business. So that was all great, Mark, and that's all really helpful, really useful, and those are some things we can go implement right away, and we can set some targets right away in our business. And now we're going to shift gears, Mark, and start talking a little bit about our asset management. So when it comes to a beautiful balance sheet, it's not just about our cash, it's also about our other assets. And we would really appreciate and would like your input on that. And let's first talk about facilities, if that's okay. So, you know, what about when it comes to owning our buildings? So give us some input there, please.
Right, so times are good. Can you afford to own your own building? And so I would suggest that to use some of the ratios we've just discussed, as well as one we'll discuss here shortly, to help you make that decision. You can ask yourself, what does the ratio look like now, and what does it look like after adding debt that would be required to finance the building? And that can kind of help guide your decision. So outside of that pure decision, a couple other things to consider if you're purchasing your own building is consider setting the building up in a separate LLC or separate company. This would help you manage your risk from a legal perspective. It also allows for future planning. Let's say you want to retire, and having the building in a separate entity helps facilitate a sale of the brokerage separate from the building. You know, you may decide in retirement you want to hold the building, but sell the brokerage. So kind of going forward, you know, what do you do now that you own your building? And, you know, times are good again. And so make sure that during those good times you're taking care of deferred maintenance and things of that nature.
Got it. Mark, I think what you just said, just that very simple strategy, own the building in a separate LLC, that is brilliant, and that makes perfect sense for all kinds of reasons. And hoping that's an aha for some people. Some people may say, well, I already knew that, but that's a good one there. That's an excellent strategy because it allows you to make those decisions independent of each other, right? And like you said, there certainly may be a time where you want to sell the business but keep the building, and there may be a time where you want to sell the building. So it allows you to be more nimble, right, and make those independent decisions.
That's right. Now, let's say that you don't have that structure set up. It doesn't mean you couldn't facilitate that in an asset sale. It just make it a bit more complicated. Right. But from a legal standpoint, and perhaps most importantly, it helps you know, shelter the brokerage from anything that happens from the building perspective.
Right. Great. Okay. Now, next, let's talk about office equipment.
Sure. So another question I often get is, you know, should I buy or lease my copier? So obviously, if you can afford to buy it, that's the cheaper route. Again, I'd encourage you to use some of the ratios we've discussed earlier, as well as one more we'll discuss shortly to help you make that decision. Generally, there's, you know, two other options other than buying, and those are obtaining equipment financing from a bank. Now, one thing I'd encourage you to look at is when you do this, ensure that your loan period matches the expected life of the asset. So for example, let's say you expect your copier that you're purchasing to last for 3 years. Don't finance the copier for any longer than 3 years. There's nothing worse than paying for something after its useful life is depleted. And then lastly, rather than equipment financing, traditional bank financing, there's leasing, and this usually contains the least favorable interest rates, but it might be attractive depending on what your current health of your balance sheet looks like.
Okay, fantastic. Good, and then related to all this, Mark, there's one more ratio that you want to tell us about.
Right, and so we mentioned that a moment ago, and that is the funded debt ratio. This ratio essentially measures how much leverage you have in your company and is calculated by taking total liabilities divided by owner's equity. So again, here I'm going to take that trust asset and liability out of this calculation. And so using the balance sheet we looked at, our total liabilities were $495,000 less the trust liability of $300,000 take that divided by your owner's equity of 105,000, and you'll see you have a 1.9, which is a healthy number for your funded debt ratio.
Okay. Great. That's another good one. That's really simple. Excellent. Okay, Mark, anything else on asset management that you wanted to cover, or is that?
I think that's what I had planned here. I will stress that the funded debt ratio is one that's also a common ratio that bankers will put in terms of your debt covenants. And so whether you're using it for these types of calculations or not in terms of making your decisions, it is useful to know and understand if you do happen to be looking for financing, as it might be something that's built into your financing package.
Okay, great. So now what we're going to do next, Mark, is pause for a minute and take questions. And we'll do this before. There are two other things that we want to tell you about, so you want to make sure you stay till the end here. And before we tell you about those two things, we just want to pause for a minute and give all of you listening live a chance to send in your question. Again, we love questions because likely someone else is wondering the same thing, and we can all learn from your great questions. We had one question that came in that just said they weren't able to hear exactly what we wanted as the target for the current ratio. Again, that current ratio target is between 1.5 and 2.0. And then Mark, we just had another question that came in. It says, I'm going to read it to you. Can you tell us again what made up the current portion of debt number, which is then used in the fixed charge cover ratio?
Yes, so the fixed charge coverage ratio actually doesn't take into account the current portion of debt. It takes into the amount of, it's going backwards in saying what did you pay in the last year for your principal and interest payments. Now, that said, your current portion of debt that's on the balance sheet will be very close to that principal payment that you made in the last year. So in the example I described, they did happen to be exactly the same. But in reality, what you're looking at on the balance sheet is your current portion of debt is going to be what's due in the next year. The fixed charge coverage ratio takes your EBITDA divided by the principal and interest payments you made on that same debt during the last backwards thinking year, if you will, plus withdrawals. Did that clarify?
I think so. And yep, and that same person just sent in a note that said, got it. So you did clarify that. So thank you, Mark, for that. I'm going to fast forward back to the slide where we were at. Great question. Thank you for sending that in. Excellent. Thank you so much for asking that. Let's we're going to pause here for another second, Mark, to see if another question comes in before we tell you about two pretty cool things that are coming up here. Let's give it one more second. Had a nice comment that just came in. Mark said, good job. So we appreciate that. We always like nice feedback.
Thank you. I appreciate that.
Yeah, you did. This is a great job, Mark. This is really, really good stuff. Well, let's do this. Let's tell you, and you still have a couple more seconds, guys, to type in a question if you have one. We'll go ahead and tell you, Mark and I will tell you about two cool things that are coming up here, two exciting things. Offered to you. One, guys, is a leadership retreat called Perform Blue. This is something that we're hosting in Denver in about 2 months. This is specifically designed for owners and managers. This is the third time that we've hosted this seminar. We've had really good reviews in the past, and all of you are invited. And what you want to do to learn more about it is to go to performblue.com. So if these are three things that you would like, if you would like more productive agents, if you would like a really clear recruiting plan, if you want to be in control of your days, then you want to be here with us November 2nd and 3rd. Go check out performblue.com. We'd love to have you there. And if you're sitting here kind of curious about this and would like more detailed information before you register, just shoot me a note. Shoot me a note right now in the question bar, or shoot me an email that says, hey, you want to get a packet of information in your hands to tell you more about this 2-day seminar. Again, it's custom designed just for owners and managers. It focuses on the 3 things that I find to be top of mind, which are coaching agents, recruiting, and also time skills. So those are the 3 things we focus on. So I'll be the host for those 2 days, and we also will have a couple of guest speakers that will offer some additional incredible value there, and can't wait to see you at Perform Blue. So go check out that website, performblue.com. We have some discounts that are going to expire here in a couple weeks, so if you've been thinking about it, now's a good time to go check it out. And then, Mark, the other thing that we want to let people know about is your roundtable, the Windermere Roundtable that you are hosting, and I'll have you tell us a little bit about this roundtable.
Yeah, thanks, Eric. And as you can see here, what the roundtable is about is one, collecting financial information from the brokerages that are involved in it. And what we do, me and my department put together accumulation of all the information supplied by the brokerages in a financial statement similar to what we looked at earlier in this webinar. And then we take that information and we calculate means and median information. For right now, we're looking at stratifying it in 3 ways. One is stratified by gross commission income per agent of above 100,000. One is below 100,000 GCI. And then lastly, a look at desk fee offices, having those 3 stratifications, as well as information for all offices that have in the study. And then what we do is we compare that information and provide your set of summarized financials alongside that information for you to use. It helps you from an opportunity to collaborate further with the owners and other owners and your peers, and really to kind of dig in and ask some questions. You might find some items that are a little bit different, and you can kind of dig in and ask the why, and perhaps improve your operations from there. Looking to expand the topics from purely financial going forward, and getting some economic data from Matthew Gardner and some legal and business tidbits from Paul Drana. We're of crunching the numbers and having that comparative feedback out to those that have bought in within the next week and a half or so here. But it doesn't mean that if you haven't supplied me with information as of now that it's too late to participate. Please just let me know if you'd like to participate, and we'll get you signed up and involved.
Okay, good. So what they want to do is send you an email.
Yes, please. Okay. And I can just be reached at mark.oster@windermere.com.
Okay, fantastic. Well, Mark, this is a chance to say to you, thank you. You're amazing. We are so blessed to have you as a resource, and just appreciate your skill set, your mindset, your servant's heart. Just how committed you are to all the Windermere owners to help them have incredible businesses. And I know I've learned a ton from you over these last 2 webinars, and based on feedback I've had from others, I know you've really impacted other owners as well. And so thank you. Thank you so much.
Thank you, Eric, and it's been a pleasure working with you on this webinar series as well as the last number of years together here. Thanks to everyone participating, and if I can be of any assistance, feel free to reach out to me and answer questions or otherwise.
Okay, great. Well, I know that we'll be seeing a lot of you in San Diego coming up here soon at the Owners Retreat. And it's a chance to say thank you to all of our guests, all the people that joined, both live and on the recording. Thanks for your input. Thanks for your feedback. Thanks for your questions. Thanks for your engagement, and cannot wait to see you soon. So I hope everyone out there just has a terrific day. See you soon. Bye.
Thanks, everyone. Bye.